The ledgers can be ledger cards. In the real world, there are ledger cards, but in this class, we use what are called T accounts. It's the same information, it's just presented a little bit differently. So every single account that you deal with, every single account that is listed on those financial statements that you learned about, cash, accounts receivable, unearned revenue, prepaid rent, common stock, all of those accounts have their own ledger card, or they have a T account that lists all of the transactions that lead up to that balance that you have put onto the financial statement, okay? So we have, now in this class, you're gonna see, for instance, accounts payable, accounts receivable, notes payable, and this is just an FYI, you don't need to remember this, but those are really called control accounts, because if you were to look at an accounts payable T account and you worked with 17 different people you bought from, and you looked at the accounts payable T account, how would you know who you owed? So really, under accounts payable and accounts receivable, there are individual T accounts for every one. So like, for instance, your customers. Under accounts receivable, you would have a T account for John Smith, Jim James, Sarah Sampson. They would each have their own T account, so you'd be able to see how much each one owes you, and the total of all those individual ones would show on the accounts receivable T account. Well, in this class, though, we don't do that. We're just using the control account just to make it simple. Okay, so every one of them has a T account. Now, this is what I was just talking about with the control accounts, that these accounts in the real world, you would have different accounts for each one of these, so that you would know, accounts receivable, who owes me money, accounts, notes receivable, what different notes do I have out there for who and who owes me, interest receivable, what customers owe me interest, accounts payable, who do I owe money to, who are the different people, notes payable, who do I owe different notes to, salaries and wages payable, who do I need to pay the paychecks to? I'm not just giving one paycheck to one person. I have to pay all the different people I owe salaries and wages to. Interest payable. So that's just kind of so you know under the surface, okay? All right, now, when we look at this slide right here, what this slide is showing us is that the accounts that are in red are the ones that you're going to use in this chapter, okay? Now you're going to notice some accounts that are not part of the entries in this chapter. We will eventually get to those ones. Like, for instance, income summary, accumulated depreciation equipment. You've seen that one, right? You've seen it in the financial statements, but we're not using that on journal entries yet. We have a whole chapter that talks about depreciation and accumulated depreciation, okay? All right, so this is an image of a T account, all right? So with a T account, and they say it's a T account because, it looks like a letter T, right? It's got a bar across the top, and then it has, we've got the bar here, right? And then we've got a bar down here, a T. So the left-hand side of the T is the debit side, and the right-hand side is the credit side, all right? Now, here's a very, very important thing that you want to make a note of. This is a very, very important thing, okay? You will only have a balance on the normal side for the account. Okay, so for instance, let's just pretend, and this is going to be sloppy, but let's just pretend that this T account, instead of saying account name, it's cash. We're going to say this is cash, right? Cash is an asset. Assets have a debit balance normally, right? So that means when we balance this T account, the balance is going to be on this left side, and it's going to say balance, and then we'll say that it has one entry of $10. It would be balance $10, okay? Now, you will not have anything on the opposite side. So if it's a debit balance account, there will be a balance on the underneath the debit side. You will not put anything in the balance section for the credit side. If it's a credit balance account, the balance will be under the credit side. You will not put anything under the debit side. Now, in the real world, can you overdraw your checking account? Absolutely. Been there, done that. So, because you can overdraw your checking account, your cash account, you could, in the real world, have a balance on the credit side, which would mean it's a negative balance for that account because it's normally a debit balance. But in this class, you're always going to have the balances on the normal side, okay? So you will only have the balance on one side. On the other side, you put absolutely nothing, all right? So let's look now at the next slide here. Okay. Now, what we're showing you here, this is actually a ledger card, and we're just showing this to you so you know how it works. Okay, we're going to be using the T accounts, not the ledger cards like this. So on the bottom is the ledger card. So up above on the first box, if you can see that, it says General Journal J1 is the number of the journal. It has date October 1, account title cash, and then it has a reference number, and then it says debit 10,000, and then it says common stock credit 10,000, right? Well, you would actually have another ledger card here, and that would be for, oh gosh, my writing is so awful on this thing. I can't do it. Okay, this would be, I'm going to just put CS. CS. So you would actually have a T account for common stock here. I don't know why on the slide they didn't do that. All right, so if we look at this, all you're doing when you're posting is you're moving the general journal items, the journalized items, to the T accounts. So you would just go line by line. So here you see that cash is debited $10,000. Okay. So if you go down below, you're going to see date October 1. That's the same as the date, right? Explanation. So you would have an explanation here on a regular ledger card, but we're not using explanations in this count, right? This is just for your information again. You're not going to do it on a card like this. This is just so you know how it happens in the real world. Okay. Reference. So where am I getting this information? Well, I'm getting it from Journal 1, J1. So that goes there. I'm going to debit it $10,000 because that's what happened. It's a debit for $10,000. And then in a ledger card, you carry the balance all the way over to the right. So it's a $10,000 balance. I'm also going to put up above in the general journal reference number 101. And reference number 101 is the account number for the cash account. Now in accounting, all of your accounts have a number. So, and in generally the way it works is that assets start with a 1, liabilities start with a 3, revenues start with a 4, and then so your cash account could be account number 101, 1001, 10,025. It just starts with a 1. That's kind of like the way it goes. So every account has a number. So this creates like a cross-reference so that if later on you have something that doesn't balance right and you need to go back and check it, what you're doing is you're going, like, let's say you knew that your balance was off $10,000. Then you would go through your journal here and you would look for any transaction of $10,000, and then you would verify that you actually entered it into the ledger cards correctly, right? So that's how it's done in the real world, but we're doing the T accounts. Okay, we're doing the T accounts. Now, you would also do the next line. You would do common stock, $10,000 credit. So you would go down to the bottom there where the sloppy T account is, and you would do a credit of $10,000 for that one. Okay. All right, let's go to the next slide here. Oh, question. Posting. So they call that posting when you post to the T account. So posting normally occurs before journalizing. Transfers ledger transaction data to the journal, is an optional step in the recording process, or transfers journal entries to the ledger accounts. And it is D, transfers journal entries to the ledger accounts. That's what posting is about. Okay. So, so just kind of a summary of the process. We determine what type of account is involved. we determine what items to increase or decrease and by how much. And then we translate those increases and decreases into debits and credits, and we journalize those. All right. So let's see.